45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Again, welcome everybody to tonight's presentation on 1031 exchanges and how to sell property, investment property without paying taxes or deferring taxes. So we have an amazing guest speaker, Erin Crowley, from Asset Preservation, that we're going to be introducing shortly. So I just wanted to take a minute to kind of explain who Marshall Reddick is and what we do for those of you that may be newer to working with us. But yeah, really excited for tonight's presentation. I would say that there's been so many more clients who are leveraging 1031 exchanges, those that have a lot of equity, who are deciding to recognize that and maybe take what I see a lot of folks from California transferring properties into other states. So we have a couple examples of that. So working a lot with Erin on situations like that, and she'll go into the more nitty-gritty details, but it's an amazing tool to help grow your overall net worth. So my name is Vince Tomich. I'm an advisor here at Marshall Reddick, and I've been with the company now for just over 5 years. My background prior to joining the team as an advisor is I was a mortgage lender for a number of years, and that's really where I learned the value of leveraging money and being able to understand that financing component that ultimately gave me the confidence to take some of this investing into my own hands, right? And I've been able to practice what I preach. As an employee here, I obviously promote what we do, the brokerage, property management, private lending, but I'm also a practitioner in that too, right? So I've been involved in my own purchases. I have Marshall Reddick managing property. I've done the borrowing and the lending, and yeah, it's definitely something that I'm like I said, a client and a fan of, as well as an employee. So it's nice to be able to communicate to other you folks who are interested in some of these topics and to be able to go into more detail. So yeah, that's a little bit about myself, and really excited, like I said, to bring Erin, because we've worked on multiple transactions together, and it's always a great for me to be included in all of those calls, because no matter how many times I'm in those meetings and those calls, there's always something new that you learn. So lots of cool stuff there. As far as who Marshall Reddick is and what we do, for those of you that may be newer. So Marshall Reddick, the way I would describe Marshall Reddick, is a full service real estate firm. And there's 4 primary services that we offer, right? So our real estate brokerage. So we help people buy and sell real estate, whether it's a primary residence or an investment purchase, right? We also do property management. So 99% of the folks that end up purchasing an investment property are going to need property management. So we service all of their needs, from marketing the property, rent collection, rent disbursement, any kind of repair request. We can handle that on the owner's behalf. And then the last 2 sections, right, is kind of under our private lending umbrella. So there's kind of 2 components there. There's the borrowers and the lenders. So we are a private money lender. So there's individuals that come to us that seek short-term financing for fix and flip loans, those that may not be able to get another conventional loan because they have too many financed properties, those that have self-directed retirement accounts. Those are all examples of people who would borrow from us because they need private money. So we service them from our private money lending platform. And then on the flip side to that, there's our investment fund. So instead of buying real estate and collecting rent checks from tenants, we give our investors the opportunity to lend their money and collect mortgage payments, right? And those are the same borrowers that I just described. Those are the individuals who we're lending that capital to. So you have the ability to join our mortgage fund, which at this point has been operational for just over 4 years, and yeah, we've been having a very consistent return on that, just about 8.5% since inception, which is awesome. And yeah, that's something that I'm happy to go into any one of those in more detail for those of you that, like I said, may be newer and want to dive in more. But that's a little bit about what we do. And my role as an advisor is to help guide you through any of the services that Marshall Reddick can, that provides. So I would be able to facilitate any brokerage transactions, connecting you to the property management team, assisting with any private lending stuff as well. So I would be a kind of our initial contact to really determine what it is you're looking for and how we can help. So I just wanted to give you guys a quick overview. I'm actually located in Southern California in our Orange County office, but you'll see here on the map, we are located across 5 different states: California, Texas, Tennessee, and as well as Kentucky and Florida. So what you're going to see here is all of the offices here that are in our that we have a physical presence. So that's either real estate, our brokerage, our property management services, or just boots on the ground, right? So you'll notice that you have we're spread pretty good here across the country, and we can offer assistance in any of these markets here. And any markets you don't see here, that's not to say they're not good markets or they're bad markets. It's just that this is where we have a physical presence that we can be the most effective. Now, what makes a good market, right? How did we decide on those markets? I think, everybody can agree that not every single market across the country is a good market to invest in. So we've taken the time to vet out some specific criteria that we feel support a strong investment market. One of those being a good job market. That's really important. Low vacancy rates is something that we look for. Economic diversity, right? We don't want to lean on one employer or one industry. Housing affordability, right? So for those of you that are like me, located in Southern California, we're at a really high price point. It's hard to make real estate work sometimes here. So seeking outside of some of those high price markets is helpful. Landlord friendly, which is crucial. Strong education, and definitely last but not least is reliable property management, which we briefly covered, and obviously a service that we can provide to you as well. So I just wanted to, this was actually a recent client who was exploring a 1031 exchange, and whoops, I went too fast. And this was just an example of somebody, who purchased, and I just wanted to kind of give some dates and some numbers, right? So purchased a single family home in San Antonio, Texas in 2018. They bought it for $184. They sold it in May of 2024 for $260, and they were getting $16.95 in rent. What's really awesome, and I get this question a lot, as I'm sure Erin does, is, those that have read about a 1031 exchange hear the word like kind. And I used to believe that was an ultra specific term, right? And come to find out, and Erin will probably go into this in more detail, it's not quite as specific. It's really more just investment, right? So I use this example because this individual, sold a single family home and was able to buy a new construction duplex. So this is a 2-unit property here on the right hand side. This was purchased in the end of August in a purchase price of $545. So as long as the purchase price is greater than the home you sold for, so the sales price of the previous home $260, buying a new home at $545, this is definitely something that a 1031 exchange fits well for. And they were able to defer all those capital gains and roll it into the next property. So bringing rent from $16.95 up to $3,500 is definitely very helpful, right? And you're able to keep what you would normally have paid in capital gains tax. You're able to roll that into a new property to essentially help you grow your real estate portfolio faster, because you're not paying those taxes at the end of each sale. You're deferring that and rolling all of those funds into the next purchase. So here's just a quick example. Now, without further ado, I'd like to introduce Erin, who, like I said, has been an amazing resource and incredible partner of ours at Asset Preservation. And we're really excited to have you on tonight. And thank you so much for taking the time, Erin.
Well, you are way too sweet, but you're absolutely right, Vince, that it helps build that portfolio faster. Because if you can imagine, every time you sell a property, an investment property, paying the taxes and then going out and buying it. And instead of doing that, just using that leverage over and over and over, you can just imagine how much faster you can build your portfolio. And you know, it's just quantitatively different when you can do it that way. So I'm going to figure out how to change my slides here. One of these minutes. So I've been doing, oops.
Here you go, bottom left. I can help you here.
What was there and then it disappeared.
There you go.
All right. So when you have investment property, one of the good and bad things of it, it's great to have investment property. That's why we're all on this call. That's why we're all in real estate, because we know that buying investment property is one of the best ways to build wealth, generational wealth, and have some income for you in your older years and just really grow a portfolio. But when you sell, you've got some taxes to pay. And a lot of my clients forget about the depreciation recapture. Depreciation is one of the benefits of having the investment property, because you get to use it against income for as long as you own that property, or as long as you're depreciating that property. But when you sell it, you have to recapture it. And sometimes we forget about that, and it's taxed at 25%. So it's a pretty high tax rate. That, in addition to the federal, and I'm not going to opine about whether or not it's going to go up or double or anything, because we just don't know. But at the moment, it's 15% for most of us. It's 20% for the high earners. And again, that's a lot less expensive than our regular income. So again, long-term capital gains is still a favorable tax rate. On top of that, I think I've got Colorado's tax on there, but your tax, no matter where you are in the country, Colorado's just went up to 4.4, but you've got to add, oh, sorry, I missed it. No, my glasses on. The net investment income tax, I forgot about that before I get the state tax. The net investment income tax, that came into play when Obama came in and put it in to help pay for the Medicare, and they just never got rid of that. So we still have the net investment income tax, and most of you are going to fit into that category with that net investment. Anything that's not W-2 income, that's 3.8%, and then state taxes. So depending if you're a tax-free state like Florida or a higher state tax like California, somewhere in the middle, you're going to be owing those 4 levels of taxes. So it's great to own real estate, great to own investment real estate, but when you have to pay the taxes, when you sell, you've got a possibility of a big tax hit. And Vince, how come that little thing goes away? Vince, can you click it? Thanks. I'll just have you click it. So this is the code that was put into the overall Internal Revenue Code back in 1921. And it's very simple. It just says no gain or loss recognized on the exchange of real property. When Trump came in, he changed that from personal property to now from property to real property. So it's exchange of property held for productive use in a trade or business or for investment if the property is exchanged solely for real property of like kind. And we'll talk about that, like Vince said, held either for productive use in a trade or business. Trade or business, easy. That's our ranches, our offices, our hair salons or factories. But it's held for investment that most of us are on this call for. What does that mean? What's the timing on that? And how do we know if something's going to qualify for holding for investment? So I'm going to go into that a little bit. Vince, is there another way I can do that?
Yeah, if you just click the screen, actually it'll change too.
I'm gonna move you back a little bit, because can you go back one?
Yep.
It's not allowing me to click anything. I don't know why.
Okay.
Go back one. Okay. So the beauty of it, sorry about that, Vince. I'm clicking, but it's not moving.
No problem.
So the pros of a 1031 is you get to defer that taxes. And because you get to defer it, you're not getting rid of it, you're just getting to use it for a while. So the money that you pay in taxes, you get to use to preserve your own equity and to use for leverage. So as Vince was saying, you could buy more. You can buy a better producing property, more producing properties. By using that cash that you would be paying the government, you might as well use it for yourself and at least use it to build and build and build your own portfolio. Exchanges allows us to diversify. So as he said, if things in California, maybe the prices are getting too high, or I'm in Colorado. Colorado is becoming very landlord unfriendly. And so a lot of clients are saying, hey, let's go somewhere like Texas or Tennessee where prices are lower, we can get some good income, and maybe they're a little more landlord friendly. So it allows you to go anywhere across the country. You can't go out of the country, but anywhere across the country that you can just change location. So if something's working for you, if you move from Iowa to California and now you want your properties near you, you can actually exchange into properties that are better suited for you. And asset class, yeah, we do sometimes think of like kind. If I saw a condo, I'm going to buy a condo. If I saw a ranch, I'm going to buy a ranch. But that isn't the case. It just has to be investment property. So I can sell land and I can buy a building. I can sell a commercial building and buy an industrial. But I can sell a piece of retail and buy residential. I can sell a single family, put that into a duplex, and a duplex to a fourplex, from a fourplex to an apartment building to a huge condo complex, and now all of a sudden I own, a bunch of multifamily or triple net properties all across the country. So starting small is the perfect way to do it, and just kind of each time you're just building. Estate planning, many of my clients use 1031 exchanges for estate planning because we have what we call step up in basis, which means that I could be building and deferring my taxes, using that cash flow to live off of, refinancing when I need cash, but I'm still building. But when I pass it to my heirs, or in my case, my dog here, when I pass it to my dog, he gets everything at a step up in basis. So all those gains that we've been accumulating go away, and our heirs get to accumulate our properties at a step up in basis. So for estate planning, it's a very, very valuable tool. Okay. I'll get the hang of this at some point. Okay. Okay. Well, clearly it wants me to do this one. Okay. So these are the basic requirements that I just want you to remember. When you're selling an investment property, so I'm saying investment property because primary homes don't qualify for a 1031, second homes don't qualify for a 1031 exchange. It's just properties that have investment components to them or investment properties. Land, you don't have to rent. It's automatically an investment property unless you're subdividing it. But if it's an investment property, if it's a residential, if you're not renting it out, the IRS is going to call that a second home, and it's likely not to qualify. So they want to see you treated on your taxes. They want to see you write off expenses, depreciation, and treat it as an investment property. So that's what they're looking for. But the basic requirements is we have to have it set up prior to closing. We don't want you to close, walk out of closing and go, oh wait, I should have done a 1031. You have to think about that ahead of time, because there's some paperwork and things in place that make it an exchange versus just a sale. So what we do as a qualified intermediary, which is what asset preservation is we're going to assign onto that contract prior to closing, have a bunch of agreements set up with you, and we're going to take receipt of those funds instead of the seller. We're going to put those funds in a nice safe account, and we're going to hold them for you. So, but if that doesn't happen, if you take the money to your own bank account or your pocket or something, you don't get to do an exchange after that. Okay. So you always have to have it set up prior to closing, even if it's right before, day of, morning of, you can still call us and get it set up. But once it's over, it's over. So always set it up prior to closing. The second thing is that we want to be careful that we keep the tax-paying entity consistent. So if we're closing in an LLC, we want to buy in an LLC in most cases. If we're closing in a partnership or a trust or a corporation, we want to keep that consistent so that the entity, the individual or the LLC that's going to get hit with that taxes if they don't do an exchange is the one who does the exchange so that they get to defer those taxes. The property qualifications, again, in like kind, we just want it to be held for investment. So if it's something you're just using friends and family, not held for investment, but almost everything else is. And there's a lot of different things that we can buy, and we'll go into that a little bit more. Tax deferral requirements, as Vince said, you want to buy higher. It's a little bit different than that. You get to pull out his commissions, title fees, the exchange fee. Those actually come off of the sales price, and that number is what you need to replace. So basically, all the cash you're going to walk away with, plus that debt that you just released. And we've got to do all of this in a very short time frame. We have 180 days from the closing of the first property to the closing of the last property that you buy. You can sell 5 and buy 1. You can sell 1 and buy 20. But you only have one time clock, and that starts ticking on the day the first property closes. Then 45 calendar days to identify, an additional 135 days to purchase it. So you've got 180 days calendar. It can be a little bit shorter or longer. It can be shorter, getting towards the end of the year, if you were to file your taxes before you finish buying your replacement property. The filing of your taxes next year could shut down your date. So you want to make sure that you complete your exchange before you file taxes for 2024 if you're closing the end of this year. It could be longer if there's like the forest fires and floods, anything that is federally declared disasters, that could make it longer. You get an extra time, but nothing else will. Otherwise, it's very much set in stone. And the identification rules, I think I've got some slides more that I'll go into those in a minute. So let me see if I can turn it. Okay. Hey, Vince, can you go back to the exchange entity? I think that's me. Okay, I got it. Am I doing this, Vince?
That one I think I did, but you were. I won't touch it.
So it's either working or it's not.
Okay.
Well, so I'll be real quick on this one. So as I mentioned, the tax-paying entity. So if you guys are owning your real estate in an LLC with more than just you, and you want to then sell that property, and not everybody wants to do an exchange together, that's when you want to call your accountant, or first call me, so that I can kind of work through what you may need to do, because we want to make sure that, again, if you want to do an exchange, you need to be on title of that property, not in an LLC, not in a corporation. Corporation can do an exchange, partnership can do an exchange, but individuals within those can't. So again, it's one of my jobs is to work through and figure out who the tax-paying entity is, and that way I can determine, that's fine, we don't need that one. I can best determine what we need to do to move forward. Like-kind properties, I'm just going to go into that just a little bit more. We can go from improved or unimproved. We can go from Texas to California. We can go back and forth. It doesn't matter what it is. It just matters how you treat that property. So if you're going to exchange one condo for another condo that looks exactly the same, but you're going to just put paint and carpet on and resell it, that's something held for sale. That doesn't qualify for held for investment. If it's something you're just going to put grandma in at no rent, that's a second home. If it's something you're just going to use, every weekend just to visit, that's a second home again. If you're going to move into it, it's a primary home. So you really have to treat it as an investment property. That's what creates the investment part of it. That's what makes it qualify. So the things that don't qualify, it's gonna drive me crazy. Go back. I'm much better at exchanges than I am at this today. for some reason. But it's not, now it should be fine. Okay, now we'll go back. I'm just going to take you back for 1 sec. Sorry about that. Okay, so it's always kind of confusing to know how much you need to reinvest in a property. And there's 2 rules about, now we know that we have to get everything set up prior to closing. We know that we've got to keep the same entity. Now we have to know how much we need to spend in order to have full tax deferral. And the rule is very, very simple. You have to take all the cash that you walk away with, all the net exchange proceeds, what you sell the property for, minus the debt, minus the closing costs, that's your net equity. You've got to put that into 1 or more properties, and you've got to replace the amount of debt that you just released with equal to or greater than debt, or come out of pocket with cash on that. So that's the exchange equation. Those 2 things are going to give you full tax deferral. If you do that, then there isn't boot, and boot is what we call the exposure to taxes. So we want to make sure you don't, sometimes you might want some exposure to taxes and you're happy to pay some. That's fine. That's called a partial exchange. For full tax deferral, this is what we're looking for. I like this one better because it shows you that it's not exactly equal to or greater than, it's a little bit less if you're working with commissions, because the hardworking realtors and are like Vince are gonna they're gonna have a cost of sale, the title companies, the escrow companies, all those are gonna have a little bit. So if you look at this one, 900 minus the cost of sales is 840, and it's the same figure as if you took all of your cash plus that debt. So the minimum amount of reinvestment I need to do on this one is 840,000 to have full tax deferral. And I can put it in 1 property, 2 properties, 5 properties. It can be a duplex, a 4-plex. It can be a land and a piece of and a condo. It can be many different things, or all of those things. Okay. So sometimes you're going to buy less expensive properties than what you just sold, and that's fine too. It just means that you're going to have some tax liability. So in this situation, if I sold for 900 and I only want to buy something for 7, I'm going to get a little less mortgage. So I'm at 40,000. We call that mortgage boot. And I put 100,000 in my pocket. That's going to give me cash boot. So I've got an exposure to taxes of 140,000. I could buy something else with that money, or I could pay taxes on it. It's kind of whatever I decide. If I'm going to go too low in reinvesting properties, and if I see that somebody's going to have gain on this property, or they're going to have boot, they're going to have 140,000 exposure, I need to go back and ask them some questions. And I'm going to say, what's your gain on this property? Or what did you pay for it? What's your basis? And if they said their basis is 100,000 and they've got $800,000 gain on this property, then maybe having 140,000 of tax exposure is fine. But if they paid 800 for that property and they only have $100,000 gain, still a lot of gain, but just spending 700 is not going to give them any benefit. So that's my job, is to always walk everybody through and make sure that the exchange is going to be the right thing for them, and that they buy enough properties to make it work. I'm just going to show you this one because a lot of times I do hear that that if you just buy equal to or greater than, you're okay, but you still have to follow those rules. If I sold for 900, I bought for $1 million, but I got too big of a mortgage and I didn't put all my cash into the first thing, I would still have some tax exposure. So we want to make sure we follow the rules of take all the cash proceeds plus replace that debt with new debt or cash. And that's how we're going to avoid it. The closing costs that I was saying that come off of there, the commissions, title fees, closing fees, legal fees, some transfer fees and recording fees. Those are the things that come up. Putting a new roof on, fixing it up, putting new carpet, getting cleaned. Those things don't come off of what you have to reinvest, okay? The new basis, I put this in just so you know that the gain just kind of goes into the next property, the next property, the next property. So it doesn't really go away. It doesn't really go away till we pass it to our heirs. there's some ways we can mitigate it, but it really doesn't go away. So the gain that I made on one property goes into the new properties that I bought and lowers our basis. So when I sell the new properties, if I put money back in my pocket, I've got the gain previous plus any new gain. And so you can see if you exchange a lot, you're going to want to keep exchanging and just keep moving that gain into next properties. Formats, we have a swap. A swap means that we're just trading properties and you don't need to QI. But pretty much every single time you want to do an exchange, you're going to need to hire someone like me, a qualified intermediary, so that we do all the paperwork, we get in the middle, we sign on to the contract, and we make it a proper, clean, and appropriate exchange for you. Multiple property exchange, I can sell 5 properties, buy one, sell one, buy 20. So it just means I can do a lot. And parking arrangements, those get a little technical. So, you know, call Vince on these or call me and he'll get a hold of me and we can talk through these more complex is when you've got to buy first and sell. But I want to make sure I get through the regular exchange first. So we have what we call a regular, forward, or delayed exchange. It's delayed, meaning that you've got time in between. You don't have to sell and buy the same day. You've got 180 days. So that's why we call it delayed exchange. It used to be that everything had to be simultaneous. So this is what it looks like. We're going to be the qualified intermediary. We're going to sign on to the contract at the purchase, at the sale of the property, and become the seller just momentarily. We're going to hold those funds. It's going to give us the right to hold those funds. We're going to hold those funds. And then when you know what you're buying, you're going to go buy that beautiful blue duplex in Texas, or you're going to find something in Tennessee, or wherever you're buying, we're going to sign on to that contract too. And we're going to momentarily become the buyer. And we're going to spend your money. So your money's going to, your deeds are still going to go from the taxpayer to the buyer, from the seller back to the seller, back to the taxpayer. But we're going to get in the middle and hold those funds safe and secure for you so that we can keep this as an exchange. The identification period, again, the whole exchange period is 180. The identification period is only 45 calendar days. So keep that in mind. Can you put contracts on before you sell your property? Absolutely. Can you, as long as you make sure that you're going to close after you sell. Sell first, then buy. That's a straightforward, easy way to do it. Okay. So we have the full 180 days. And as I said, it can be cut short by the day we file our taxes for the year of our exchange. So anything happening at October 14th and beyond, I've got to remind people to complete the exchange before they pay their taxes. The 45 days is absolutely set in stone. You want to make sure that you get that list to us of the properties before midnight. And you're probably wondering how you do the identification list. So these rules came to us in the 1990s. They haven't changed in decades. So there's 3 rules we have to abide by. One says that I can identify up to 3 properties and I can be of any value. So if I sell for 900, I can identify a property for 1.8 and maybe one for 2 million and one for 900 and maybe just one for 850, as long as I only do 3. So most of us are just identifying 3. But you might be going somewhere where it's less expensive. You might be selling $1 million property and going to one of these other states where things are less expensive and you can buy multiples of them. You might need to buy 5 of them to spend all your funds, in which case you would go into the 200% rule. And that says that you can identify as many properties as you want, but you're capped at the amount. So you're capped at twice what you sold your property for. So in my example, I sold for 900. I can identify up to $1.8 million worth of properties, and that could be 5 properties or 20 properties, depending on their values. But I'm capped at the value of the property of twice what I sold my property for. And if I blow both of those, if I identify 3 or 4 or more properties and I go over 200%, then the 95% rule applies, and I have to identify I've got to close on 95% of the properties I identified. That's a tricky rule. So most of you guys are going to be in that 3-property rule with a 200% rule. Okay, and these are the rules that came to us in the 1990s. We didn't have faxes back then. We had telecopiers. So gotta be made in writing. You have to describe the property. You can't just say, I'm looking for a 3-bedroom, 2-bath in Kansas or something. It's got to be ambiguous. 123 Main Street. We have to receive it. It's got to be sent by mail, fax, or by email by midnight on the 45th day, and it has to be delivered to the qualified intermediary, or the only other entity is really the title company, the escrow company that can receive those, because your attorney, your accountant, all those people are actually are disqualified from that. This is the form that you have to fill out for the exchange. It tells you what you're going to buy, what you did, how much you spent, what you sold, and this is what's going to tell the IRS what you bought and how much your taxes that you've deferred. I missed some. I'm going to go back real quick, and I know that Vince, you have a few things afterwards, don't you?
Yeah, no problem. Take your time.
Okay, I just want to go back. I missed some things on the using both the 121 and the 1031. That I think we're back behind here.
That's a really cool opportunity to do that too. So that's great too.
Okay, yeah, I wanted to make sure I didn't miss this. So this slide's important, especially nowadays when we have a lot of folks who are kind of house hacking and doing ADUs and Airbnbs. So there's another section of the code called section 121. And if you have your own primary home, you're familiar with that. It says that if you're living as your primary home in a property for 2 out of the last 5 years, it can be the first 2, the middle 2, the last 2, 1 year in the first, 1 in the end, it doesn't matter. As long as you can cobble together 24 months in the last 5 years, that was your primary, you get to, you likely qualify for the 121, which is $250,000 exclusion on your taxes, or $500 if you're married, exclusion on your taxes. So that's an exclusion. It doesn't get kicked down the road. It just goes away. You get to exclude it. So it's a beautiful thing when you can do that. But when you can mix that with a 1031 exchange, it's a really great strategy. So a lot of times we'll see a house with an ADU on it, and you're writing off that, you're treating that ADU, that carriage, that duplex, that fourplex, your lock off, your ranches, if you have a ranch house on a big ranch, those things that we can do, we can carve off the part that's your primary home, we can use that exclusion, and then the remaining amount of it we can defer. So there's many instances where if that primary home portion covers your primary, and then that 1031 helps you defer the remaining tax. So if you're working in some of those areas where you've got both those components, call me and I can walk you through that. I had somebody the other day who was thrilled that they could do that because they thought they had to choose between the primary home exclusion.
Can I ask you a quick question on that, Erin?
Yes, please.
When you do the exclusion, when you take advantage of the 121 exclusion, are you, when you're finding your up lake property, when you're finding your new purchase, do you get to just seek out a property like less 250 or less 500 of your relinquished property? So do you get to search like actually down in purchase price, or how would that work?
You would, because you're pulling out basically that 250 or that 500 from the exchange and you don't have to then reinvest it. It would be looked at as boot basically, but you've got an exclusion against it. So
Okay.
you can pull it out and not have to pay taxes on it. And then you're deferring the remaining amount. So it's very helpful. So a lot of times, if somebody calls and says they've been renting this property, now it's only the 2 of the last 5 years. So if you rent your property, you let's say you move out of your residence and you make it a rental, great strategy. But if you rent it for more than 3 years, 3 years and a day, then you no longer live there 2 out of the last 5, and you lose that ability. So it is a good strategy. The other strategy that I don't mention here is that you can buy a rental property and you can move into that in the future. So let's say I want to move to Tennessee as my resident in my retirement home, so I can sell my investment property now. I can buy something in Tennessee or Texas or California or Florida or wherever I want to be, and I can rent it for 2 years, is what the IRS likes to see. Then I can move into it and make it my own and make it my primary. And when I do that, it allows me to, over time, not immediately, but once I hold it for 5 years, then when I sell that property, I can mitigate those taxes by using my primary home exclusion. I don't get all of it. I only get the time that I lived there versus the time that I owned it. So it doesn't get rid of it, but it might, but its chances are it will help mitigate it. Over time, you get to use more and more of it, or I could just live there forever, leave it to my heirs, and never pay those taxes. They just went into my primary home, and I got to, live in a nice place and leave it to my heirs. So there's some great strategies with that, with using both these different tax codes.
Yeah, awesome. So Erin, thanks for explaining that. I feel like that's such an amazing opportunity, and and it's such a nuanced part of a 1031, but so valuable, because it's rare that you can actually, in the process of doing 1031s, to actually pull money out and put it in your pocket. That's a rare opportunity in real estate to not pay tax on it, of course, right? You can always do that. It's just not paying tax on it is the rarity. So that's great that you brought that up.
And what happened is, in most of our markets, the appreciation in the last couple of years has been so much that primary home exclusion on their primary home hasn't really been, it doesn't really get rid of anything. So hopefully, it only works if you have an investment component to you've got both of them. But it's brilliant if you can't just have something in your basement, but if you have a studio or a lock off or something, keep in mind those other things that you can defer. If you have a cell tower, if you have an easement, those sort of things are exchangeable as well. And so there's a lot of things that you might have, water rights, mineral rights, some things that you own or you have possession of, that you can actually, take to go through an exchange, call Vince, buy something else, buy an income producing property with them. So keep in mind that there's some things like that, water rights and mineral rights, that maybe don't income produce, but they can be exchanged for an income producing property. Do you have any questions, Vince?
No, nothing yet. I am going to see if any questions come up that we may have missed, but I'll kind of also go into just like some examples of, some properties, right, that could be good examples of exchanges, right? Because we have a lot of folks that may be thinking in their head, well, maybe if I do sell this property, but what would I buy, right? Like, what would that look like? So I just wanted to include a couple of quick properties just to show you guys some examples. This is a kind of one of our, I would say, best opportunities in Texas. It's a new construction duplex where, right now, one of our biggest headwinds in real estate, as most of you folks know, is interest rates, right? Interest rates being higher and therefore making it harder for these properties to cash flow. But, what we've seen from a lot of builders and developers is individuals who are applying incentives, and those incentives are typically most effective when being applied towards the interest rate. So you'll notice here the interest rate is 4.75, and that's on an investment purchase, right? An investment duplex purchase, which, if you go walk into a bank and get quoted for an investment purchase, even though I know there's mention that rates are coming down a little bit, they're still very far away from 4.75. So I would argue that this is what kind of the benefit that you're getting now in this market. When rates are down naturally, when they're lower naturally, it's the complete opposite, right? There's zero incentives. You're paying over the list price. There's a lot more not in your favor. So these are kind of some of the things here. So, and I'm not going to go through line item, but I just kind of wanted to quickly, maybe on this first one, I'll show you kind of just the breakdown for those of you that are less familiar. On the right-hand side here, you'll see, it starts with the list price. We have a down payment of 30%. Technically, you can put 25% down. Most of what you're going to see on our website for multifamily is 30% down. Initial repair cost at 0, being it's new construction. We have our estimated closing cost there. And then you'll get your total capital needed at 206. So this is the list price, that 649,500. That is the purchase price that you're looking to replace when you're doing a 1031, right? So if you sold for 550,000 and you wanted to buy for 640, you're going to eat up all of those funds that you need to. So this would work perfect, right? And then you'll see gross rent from both units, 4390. You back out the mortgage, you back out the taxes, the insurance, the management fee, the HOA. And you'll see that the total fixed expenses there of 3894, you're left with a monthly income of 495, right? Which is great. Now, anybody who owns real estate knows that there's going to be maintenance and vacancy. New construction, it's going to be significantly less. We have it at 5%. I would argue the first year is almost going to be 0, just based on builder warranties, etc. But when you factor those in, there is a slight negative. But I guess what I want people to understand is that is assuming that there is going to be in that first year 8% maintenance, 5% maintenance, 8% vacancy, along with a 50% leasing fee, which we've factored in. That's to place tenants. So you will see here how those numbers translate. And then at the very bottom, right, this is just a screenshot. It's hard to show that our online calculator is much more interactive. You can adjust numbers, you can change things, and you can see how the amount of time you hold the property is going to determine the overall return. So you'll see here we have an estimated 15-year hold. So at a 15-year hold, your projected profit is expected to be just short of 700,000, and your basically annual return on investment over those 15 years is going to be just over 22%, right? Now, what is the biggest component of that? The biggest component of that is the appreciation trend, right? So the appreciation over the next 15 years is how we go ahead and factor that in. And we have data from the National Association of Realtors over the last 25 years, and we take a much more conservative approach on that, just below what the average is. So that's how we generate that income or that number. And these numbers are also making the assumption that rents do not increase over the next 15 years. So I know for those of you that have been renters or that are renters now, you understand that is definitely not something that would be accurate, right? Rents don't just stay flat for 15 years. They're traditionally going up, and sometimes it's every year, maybe it's every other year, but they typically are going in an upward direction, right? And I know there could be some softening in some markets, but when you look at a long trajectory, that's what we're seeing and what we have for data. So here's just one example of a property in Texas. This is Buda, which, like I said, is in South Austin. Here's one of our properties, another new construction in Lehigh Acres. That's that southwest side of Florida. Kind of same concept with this builder. And you'll notice that I'm bringing up mainly new construction. Like I said, the reason for that is, who are the folks right now that have the biggest need to negotiate and the need to sell their property? It's those that have the most inventory. Well, who has the most inventory? That's typically going to be builders. So again, that's where we're finding our builders who are willing to offer incentives. This builder is able to get the interest rate down to 5.25%, right? Which is still amazing. And you'll see after all of the financing here, about 550 purchase price, 30% down. Rents at 3790 for the both units combined. And when you have your fixed expenses at 3100, you're left with 660, right? 660 a month. And then you back out your maintenance and vacancy, and you're just over you're at $65 a month, right? So again, that's assuming that's day one. That is day one outlook. A lot of times, for those that are more familiar with real estate, as time goes on, the numbers tend to improve, right? Rents are going up, like I mentioned. You have the opportunity to do refinances and potentially lower the rate. You're starting at a very low rate now, so that's not I guess a factor that I would be holding my breath for right away, just based on the starting of your, the rate that we're getting. But nonetheless, those are all things that help improve the numbers over time. So something to also consider here is, just like I said, another example in Florida. And then lastly, I have a single family home here in Clarksville, Tennessee. These have also been an amazing build for a lot of our clients. A little bit more attractive purchase price. Again, the builder is offering incentives that we're applying towards buying the interest rate down. Now, you're not forced to do that. For those of you that may not be financing, what about those that are thinking, well, I don't have to finance, right? Well, that's awesome too, because then you don't have to worry about dealing with financing and obtaining loans. You could typically take these incentives and take that off the list price, right? So I would say, for those that are saying, well, if I'm going to get $30,000 or $25,000 or $40,000, whatever the amount is in incentive, some people may say, I want to take that off the list price. And in many cases, you can do that, even if you want to finance. In some cases, it's case by case with the builder and the offer, but there's times where you can take that off the list price. But what I would tell you is, I've had to run these scenarios multiple times, and typically taking $40,000 off the list price, or taking that $40,000 and taking a 7% interest rate down to a 4.75 or 5.25% interest rate, makes a much greater impact. So something to consider when based on what I'm kind of describing when I keep saying incentive. And you'll see the breakdown here as well, right? So you have that monthly income of 95 and that annual return on investment of just under 11%, I should say. So again, those are just quick snippets, quick examples. I'm happy to dive into any property examples in more detail, or go over just scenarios in more detail for any of those that are interested. I wanted to let you know that any properties that you see on our website, they are going to have a rating next to the property. That is our Reddick property rating. So we basically have from A to C class properties. A lot of that is based on price in a specific metropolitan statistical area. So this is a good book for those of you that are looking for more information on that. That could be really helpful for you to read up on and just get a better understanding of how we rate properties. There's, for those of you that are, of course, our education, you're on one of our webinars tonight, but if you're looking for more educational videos, articles, guides, it's all free on our website, marshallreddick.com/learn. And then for those of you that may have missed anything or are interested in re-watching this is recorded, so we'll be sending a recorded version out along with the PowerPoint to look it over. And if anybody has more specific questions, I will be doing follow-up calls this week just to check in, see if there's anything we missed or anything we can kind of dive into in more detail. I wanted to take the time though to thank Erin. Really appreciate all of the information and all the guidance here. And yeah, it's always a pleasure to join you on these webinars and to be working with you.
Same here. The clients that I get with you are just thrilled with your service and with Marshall Reddick. So they're very happy clients.
Awesome. Well, Erin, thank you so much. And thank you guys all so much for joining us this evening. I look forward to talking to you all this week, and I hope you have a great rest of your evening.
Thanks, guys.